Adjusting entries are meant to assign revenues to the period in which they are earned and expenses to the period in which they are incurred. They also update the asset and liability accounts on the balance sheet. This end of period process is called making the adjusting entries or adjusting the books or accounts. Adjusting entries are needed for a couple of things. One is to accurately measure the period income on the income statement. And second, we use adjusting entries to bring related asset and liability accounts to their correct balances on the balance sheet. The two basic types of adjustments are called prepaids, which are deferrals, and also accruals. So to define these more formally, prepaid is, as the name suggests, the cash is paid or received before the related expense or revenue is recorded. Prepaids are also called deferrals because the recording of the revenue or expense is deferred to periods after the cash flow. Accrual is the opposite of prepaid. Revenue or expense is recorded before the related cash is received or paid. So let's have a look at this diagram here, which does a good job of illustrating what I'm talking about. In a prepaid situation, you have the cash flow happen first, and then, as the arrow points out, you have your revenue or expense recognition after. In case of an accrual, on this side, we have the revenue expense transaction recorded first, and then we have cash received or paid. So in terms of timeline, we're flowing from left to right. The difference between the two is just the cash flow happening either before in a prepaid scenario or cash flow happening after with an accrual. Some example of prepaids, we have prepaid expenses. So for example, if you pay for your rent in advance, you have amortization. So this would be a situation where you buy a capital asset and you use it up over time and you recognize the expense on that asset slowly as you use it. And finally, we have unearned or deferred revenues. So this is a situation where a customer pays you in advance for a product or service, and you are now obligated to fulfill your side of the deal. Moving on to accruals over here, we have accrued expenses, which is you've used something in a certain month or period, but you haven't dealt with the cash flow yet. So an example might be an employee working for you. You owe them money for work done, but you recognize that portion of that employee paycheck in the current month before you close the month off or you close the quarter off. That's an example of an accrued expense. An accrued revenue where you've done some work for somebody, but you just haven't gotten around to billing them yet. Since the work is done in the current month or quarter or year, you go ahead and recognize the revenue. So we'll look at more specific examples of all of these as we proceed through the course. So prepaid expenses, advance payment of expenses. As we saw earlier, rent is one of the most common expenses, which can be prepaid in the business world. And now we're going to go to an example, and we're going to use prepaid insurance. Lucia purchases insurance for her business each January 1st. By paying a year's worth of premiums, $1,200 upfront, she saves herself the trouble of writing a check each month. Here is Lucia's journal entry on the date of purchase. So January 1st, 2020, we have a debit to prepaid insurance for $1,200 and we pay with cash. So a credit is cash for $1,200 and we have a brief description. Paid annual premium for business liability insurance. So naturally, we take this journal entry, we post it to the general ledger, and our prepaid insurance T account looks something like this. It's in the asset section since it's going to help us make money going forward. And on January 1st, we have a debit of $1,200. Just copying down straight from here down into here. Assuming Lucia makes adjusting entries on a monthly basis, 1/12 of the insurance premium paid will be used up and expensed each month. At the end of January, Lucia will make the following journal entry. So we will have on January 31st, 2020, insurance expense recognized for the month, so that's 100, and prepaid insurance credited for 100. That portion of the prepaid insurance asset we no longer have since it's now been used up. Look at our calculation down here. We have a brief description to record insurance expense for January, and then we have 1,200. That's your annual premium multiplied by 1/12, so 1 month out of 12. Let's look at the general ledger now. So we have the same key account we looked at earlier, the prepaid insurance. It now has a credit of 100. So our net debit balance remaining in prepaid insurance at the end of January is $1,100. Looking over at the expenses side, we have insurance expense, and we have one entry added on of 100 for the month of January. The adjusting entry made for the month of January would also be made in each subsequent month in 2020. This is an example of a very simple using up of prepaid insurance, since an equal amount is consumed each reporting period. Insurance expense is always debited $100 and prepaid insurance is credited $100. However, what if there was another expense which wasn't used up so uniformly? Question: what if Ty purchased office supplies for his business in bulk and wanted to accurately report the usage and amount remaining on his financial statement? Is this a feasible goal? Yes, Ty can use the following formula. So we take the cost of asset that's available during the period. So that's basically what you have at the start. Then you take away the cost of the asset on hand at the end of the period. And the difference ends up being the cost of asset used or expense during the period. Let's assume that Ty bought office supplies for $2,000 at the start of the quarter. If he measured $1,500 worth of office supplies at the end of the quarter, how much of the asset was used up this quarter? So I'll give you a minute to work on these first three questions here, and we'll go over it in the same video. Okay, so answer here is going to be 500. So we have 2,000 available at the start of the quarter, and then 1,500 remaining at the end of the period. And the difference, 2,000 minus 1,500, will be 500. So let's look at the next two questions here. At quarter end, the office supplies T account shows up. So we know office supplies are an asset. They help the business earn a profit, hopefully. So being assets, it will have a debit balance. And since we have 1,500 left at the end of the quarter, that's the amount that should show up in our T account. Second question, at quarter end, the supplies expense T account shows a debit or credit balance. So again, expense, when they go up, we have a debit balance. And looking over here, we had 500 of supplies used up. So our supplies expense T account will show a debit of 500. So let's stop this video here, and you can try this journal entry for supplies expense for the quarter, and we will go over it at the beginning of the next video.